own a broad slice of the market, add to it steadily, and hold it for decades. The hardest part of that plan is not the buying, it's the holding. It's sitting still while the value of your shares drops. The headlines turn grim, and every instinct you have says sell. That's why it's your own behavior, not the market itself, that's the real obstacle. Hi, I'm Andy Temte, and welcome to Money Lessons. Join me every Saturday morning for bite-sized lessons that are designed to improve financial literacy around the world. Today is August the 1st, 2026. Last week, we made the case for owning stocks over a lifetime. The equity risk premium, which is the extra return stocks have paid their owners for taking on more risk, and compounding, which turns that yearly advantage into a life-changing sum. But I ended with a warning. The equity risk premium is real and is neither free nor guaranteed. Today, we look at the other side of the case, what the equity risk premium costs you and why trying to dodge that cost usually backfires, and why the biggest obstacle to earning the equity risk premium is very often our own behavior. Now, every reward in investing has a price. The reward here is the equity risk premium, the higher average return stocks have paid over bonds and cash. The price is volatility. Price is just a word for how much and how sharply a price moves up or down over a particular time period. Stock prices, they move a lot. You earn the equity risk premium precisely because you agree to hold your shares while their price rises and falls, and not to sell when the price is falling. The swings in the stock market can be severe. Since 1928, stocks have finished the year higher about 73% of the time, roughly 3 years out of 4, but the down years can be really bad. In 1931, the worst single year on record, stocks lost about 44% of their value. And the down years tend to arrive in clusters around a specific shock: the Great Depression, the dot-com bust, the 2008 financial crisis. The equity risk premium is also not guaranteed to show up on a schedule of your choosing. Take the 10 years from 2000 to 2009. A dollar invested in American stocks at the start of that decade came out 10 years later, roughly, where it went in. 10 years and essentially nothing to show for it. Now stretch the horizon out. Since 1928, no 20-year stretch has ended in a loss, not even for the investor who bought right before the 1929 crash or right before the 2000 peak. Over 20 years and longer, the swings have averaged out. Over 1 year, over 3, over 5, they haven't. None of this is a promise about the future. It's the record of the past, and the future can always turn out differently. You've probably heard the fine print at the end of a brokerage or investment company ad says, "Past performance is no guarantee of future results." That's exactly what we're talking about. Even so, 20-year periods and positive return is the most dependable pattern nearly a century of data has to offer. That's the bargain. Volatility is what you pay, both up front and along the way, for an equity risk premium that only reveals itself with time. So here's the natural question. If stocks crash every so often, why not just sell before the crash and buy back after? Sounds really smart, doesn't it? But almost nobody manages to sell before the fall and buy back before the recovery, and there are two reasons why. And oh, by the way, if somebody's trying to tell you that they know how to do it, yeah, they probably got lucky. The first reason why this is so hard is that the best days and the worst days sit right next to each other. The market's sharpest recoveries tend to arrive right after its steepest falls. Look at 2008 and 2009. In 2008, at the depth of the financial crisis, American stocks fell about 37%. The very next year, in 2009, they rose about 26%. An investor who sold in the panic of 2008 to stop the pain would have been holding cash through the 2009 rebound, turning a paper loss into a real one by selling and then missing the recovery that followed. The second reason is that timing the market means being right twice. You have to sell near the top and buy back near the bottom. Get either one wrong and you come out behind. And the moment when buying back pays off the most, right after a crash, when the headlines are the darkest, is exactly the moment it feels the most dangerous to do it. The long-term record bears this out. The research firm Morningstar tracks the gap between what mutual funds earn and what the investors in those mutual funds take home once you account for when they buy and sell. Over the 10 years ending in 2024, the average investor earned roughly 1.2 percentage points a year less than the funds they owned returned over that same period, a gap that traces to when they chose to buy and sell. And the more they traded, the wider that gap tended to grow. Researchers debate how much of that gap comes from bad timing versus other causes, but the direction really isn't in question. Moving in and out has tended to cost people money, not earn it. Now, modern trading apps have made investing free and frictionless. No commission, buy a fraction of a single share, tap once and it's done. That access is a genuine good, and we've celebrated it in this series. But the business underneath those apps has an interest that runs counter to yours. Back in our July 11th episode, we saw that many brokers don't charge you a commission because they make their money another way. They route your orders to large trading firms and are paid for that flow, which means that they earn more when you place more orders. That puts the tool's incentive in direct opposition to what builds your wealth. Now, one kind of repeated action does build wealth. Setting the app to pull, say, $10 a day and invest it automatically in a broad index fund month after month without a second thought. That is disciplined, automatic investing, and it is exactly the thing you want to do over and over. The trouble is that these apps are also built to pull you toward a very different kind of repeated action, reacting. The price alerts, the notifications, the little celebration when a trade goes through, every bit of it nudges you to check, to judge, and to trade in the moment. Automatic investing and reactive trading can live on the very same app. And it's the reactive trading that the long-term record tells you to avoid. Now, no app sends a notification praising the investor who stuck to the plan and places no trades that day. But over 30 years, that quiet investor is the one the record rewards. So, what does all this mean for you? Everything in this series has pointed in one direction. Own a broad slice of the market, add to it steadily, and hold it for decades. The hardest part of that plan is not the buying, it's the holding. It's sitting still while the value of your shares drops. The headlines turn grim, and every instinct you have says sell. That's why it's your own behavior, not the market itself, that's the real obstacle. The equity risk premium is there for anyone willing to hold through the bad stretches to reach the good ones. The way to manage that is to decide in advance while you're calm so that you're not leaning on willpower in the middle of a crash. Automate your buying so it happens without a decision. Diversify so no single company or country's failure can sink you. and settle it in your own mind on a quiet day that you will not sell in a panic. The plan you make on a calm Tuesday is the one that protects you during a wild Monday. Now, we've spent a long time on equity, from the very first shareholders centuries ago to the mechanics of owning a share today. If you carry one idea out of all of it, carry this. Over a lifetime, the stock market has rewarded the patient owner far more reliably than the clever trader. Next week, we turn a corner. From here, our focus shifts to the money that runs through your own life, how you earn it, spend it, borrow it, and hold on to it. That's the work of personal financial management, and that's where we're headed next. So until next week, I wish you grace, dignity, and compassion. My name is Andy Temte. This is Money Lessons. You can find the show on all the major streaming services as well as out on YouTube. Please like, subscribe, rate, and most importantly, share this public educational good with your friends, your family, your colleagues, and maybe a neighbor. The show is produced by Nicholas Temte, and we'll see you next time on Money Lessons.